company does not have at least 1 out of 8 competitive advantages, the stock returns will be below average over the long term, and Warren Buffett agrees with this. He once said, "The most important thing when evaluating a business is figuring out how big the moat is around it." He wasn't talking about castles, though the image fits perfectly. In investing, a moat is what protects a company from the competition that inevitably comes when it starts making money. It's the invisible wall that keeps rivals out and profits in. And in Buffett's world, a company without a moat isn't an opportunity, it's a target. The moat gives the company the protection it needs and a long runway for growth. The idea of the moat didn't start with Buffett, but he made it famous. He first learned the concept from his mentor, Benjamin Graham, who focused on margin of safety, the idea that you should only buy a stock when it's selling far below its true worth. Buffett took that idea and extended it from numbers to business quality. He realized that buying cheap companies was fine, but buying great companies with strong moats was far better, because a strong business compounds wealth while you sleep. Later, Charlie Munger pushed him further. He taught him that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. From that moment, Buffett stopped hunting for bargains and started searching for moats. Why moats matter so much? In capitalism, profits attract competition like gravity. Every time a company earns excess returns, someone will try to copy it, undercut it, or do it cheaper. If nothing stops them, those returns eventually disappear. Buffett understood that the real magic of compounding comes from durability, not growth. Growth, of course, is very important, but without a moat, this growth may soon vanish. A moat isn't just what makes a company successful today, it's what keeps it successful for decades. So when Buffett says he's looking for economic castles protected by unbreachable moats, he's not looking for the next big trend. He's looking for the rare companies that can defend their profits, the ones whose advantage gets stronger the longer they exist. Thus, the risk of the investment becomes lower over time instead of higher. I will now explain the 8 types of moats. In his book 7 Powers, Hamilton Helmer describes the key types of strategic advantages that allow companies to sustain superior returns. I have been investing since 2013 and I have not seen or watched a deep dive video on moats anywhere on YouTube. As a matter of fact, I have not seen a lot of key information in regard to proper quality investing. This is why I decided to start this channel and journey. Let's discuss the moats. In the book, these 7 powers line up closely with what Buffett has talked about for years. But it's worth expanding the list slightly, making the powers 8. Let's explore the 8 moats every investor should understand. Number 1, network effects. The more people use a product, the more valuable it becomes. That's the essence of a network effect moat, when each new customer makes the service better for every other customer. Think of Visa. Every new merchant that accepts Visa makes the network more useful for consumers, and every new consumer makes the network more attractive for merchants. The result? A self-reinforcing loop that's almost impossible for new entrants to break. The same applies to Facebook, LinkedIn, or Airbnb. Their networks grow stronger with every user, not weaker. Buffett loves this kind of compounding advantage, one that feeds itself over time. A very important key distinction to make is that a moat is not enough for a company to be called a great investment. There are 4 key pillars which make an investment great. To have a competitive advantage / this is the moat. To have low debt levels so that the risk is not high. To have a high business efficiency, think high margins, high ROIC, ROE, etc., and a low price in relation to the company's growth and fundamentals. Just like a traditional dining table has 4 legs which make it stand stable, a company must have all 4 pillars. If a company lacks one out of these 4 key pillars, sooner or later, it shall not be a great investment. The moat makes the company great, but the moat is not enough to make the investment in that company great. Debt, price, and the efficiency of the capital management must all align. Subscribe to the channel as I will share my decade-long experience with all of you for free. You will not regret subscribing, I give you my word. The second type of moat are the economies of scale. Some companies win simply because they're big, and their size allows them to operate more efficiently than smaller rivals. When a company spreads fixed costs like distribution, R&D, or marketing over a massive customer base, its per unit cost drops. That allows it to lower prices and maintain margins, something competitors can't match. Walmart is the textbook example. Its scale gives it unmatched bargaining power with suppliers, letting it deliver everyday low prices that smaller stores can't afford. Amazon has taken the same principle to the digital world, using massive volume to fund logistics and infrastructure others can't replicate. Economies of scale are a moat that grows wider as the company grows larger. Number 3, high initial cost of capital. Some businesses are protected simply because it's too expensive to compete with them. In 2009, Buffett bought such a business. It was Burlington Northern Santa Fe, one of North America's largest freight railroad companies. It operates an extensive network spanning the Midwest, Western and Eastern United States, as well as parts of Canada. Imagine trying to build another BNSF railway. You'd need tens of billions of dollars, years of construction, and regulatory approval across dozens of states. By the time you were done, your competitor would still have the better routes, relationships, and efficiency. That's a moat made of steel and concrete. Literally. Industries like pipelines, utilities, and telecom networks have similar dynamics. The upfront investment acts as a wall that few can afford to climb. In the description of the video, I shared a free document which is a stock list of 30 companies with their respective moats. I'll put it as a pinned comment as well. You can download it for free. Number 4, switching costs. A business builds a moat when customers find it painful to leave. It's not always about money. Sometimes it's time, effort, or habit. Adobe is a perfect example. Once you've learned Photoshop or Premiere and built your workflow around it, switching to another tool is a nightmare. You'd lose time, retrain your team, maybe even risk data compatibility. Enterprise software like Salesforce and Microsoft 365 thrive on this advantage. Once a company adopts them, they become deeply embedded in the organization. Switching costs turn convenience into captivity, and captivity into compounding revenue. Number 5, regulatory advantages. Sometimes the moat is built not by the company but by the government. Licenses, laws, and regulations can create legal barriers that protect businesses. In industries like banking, insurance, or pharmaceuticals, it's not easy to just start a competitor. Buffett's holding Moody's is a classic example. It's one of only a few companies officially recognized to rate bonds for regulatory purposes. Even if someone built a better system, they'd still face years of bureaucratic obstacles to gain the same trust and status. When the law itself protects your business, your moat runs deep. Number 6, intellectual property. Ideas can be copied, but legal protection can make copying expensive. Patents, trademarks, and proprietary technology give companies exclusive rights to profit from their innovations. Pharmaceutical companies enjoy patent protection on new drugs, ensuring years of monopoly profits before generics arrive. Of course, this moat fades when patents expire or technology changes, but during its lifespan, it can be incredibly powerful. Number 7, brand power. A strong brand is a shortcut in the human brain. It creates trust, familiarity, and emotional connection, often allowing companies to charge more for the same product. Buffett's love for Coca-Cola comes from this exact principle. He once said, "If you gave me $100 billion and said, take away the soft drink leadership of Coca-Cola, I'd give it back and say it can't be done." That's brand power. It's the reason people reach for the same red can even when cheaper options sit next to it on the shelf. Apple, Nike, and Disney share this kind of magic, where perception itself becomes protection. Number 8, pricing power. Finally, the ultimate test of a moat. Can the company raise prices without losing customers? Buffett once said, "The single most important decision in evaluating a business is pricing power." If a business can raise prices a little every year and customers barely notice, it means it provides real, irreplaceable value. American Express shows this perfectly. Its brand, prestige, and network allow it to charge merchants higher fees, and people still line up to carry the card. Apple does it too. Each year, it releases a slightly more expensive iPhone and demand barely moves. That's not luck, that's pricing power, the purest expression of a durable moat. Coca-Cola also does, Facebook and Google do it with their ad platforms, Netflix does it as well. Moody's, S&P Global, Visa, and MasterCard all have this in common. Real companies rarely have just one moat. Often, the strongest businesses combine several of them into an interlocking defense system. Take Google's, it has network effects, more users equals better search data, economies of scale, massive infrastructure, intellectual property, algorithms, and brand power. We literally use Google as a verb. Or Amazon's scale, logistics, switching costs through Prime and brand trust. A fortress of moats reinforcing each other. Buffett's genius lies in spotting these compounding advantages long before the market appreciates them. He's not betting on innovation, he's betting on endurance. Buffett built his wealth not by investing in small, unrecognizable companies, but in the biggest and already proven business in the world. What built his wealth is long-term thinking and vision. When Buffett evaluates a company, he doesn't just ask himself, how fast is it growing? He asks, how long can this advantage last? Because in the end, the value of any business is the present value of its future cash flows. Remember this saying, we will come back to it again and again in this channel. The value of any business is the present value of its future cash flows, and the durability of those cash flows depends entirely on the size and strength of the moat. That's why he's comfortable holding companies like Coca-Cola or American Express for decades. Their advantages don't fade quickly. He's not chasing opportunities, he's protecting compounding. Modern strategy thinkers like Hamilton Helmer, in his book 7 Powers, have mapped this logic in a structured way. Helmer explains that every sustainable business advantage comes from one of a few fundamental powers, like scale economies, network effects, or switching costs. Buffett discovered this intuitively long before it was formalized. He understood that capitalism is a brutal machine. Without a structural power, every profit will eventually be competed away. Helmer's framework gives language to what Buffett and Munger practiced instinctively, and studying both together gives investors a complete picture. Buffett teaches you how to think about quality. Helmer teaches you how to identify it. In the end, moats aren't just about business, they're about resilience. The quiet strength to last through decades of change. Buffett built Berkshire Hathaway not by chasing new opportunities, but by finding businesses that didn't need to reinvent themselves every 5 years. He found power in patience, because in a world obsessed with speed, the real advantage, for companies and investors alike, is the ability to endure. When Buffett talks about moats, he's really talking about time. The only asset you can't buy back. A wide moat gives a company time to grow, time to compound, and time to reward its owners. It's not about beating the market, it's about staying protected long enough to let compounding do its quiet, invisible work. And maybe that's the greatest moat of all, the discipline to wait for the businesses that can last a lifetime, but never forget the other 3 pillars of value and good stock returns: price, debt, and efficiency. In the description, you can grab my free list of 30 companies with strong moats and their types. Thanks for watching, and I'll see you in the next video.